Hey guys, welcome to this video. I'm going to start a series that talks about the fundamentals of the stock market, which goes through from the principal ideas such as what is the stock market, the basics of exchanges, to slightly more advanced topics including the risk management, technical analysis, etc. And the reason why I am starting this series is because I believe everyone will be involved with the stock market from one way or another. So whether if you are in this generation where you are maybe picking and actively trading a portfolio of your stocks, or maybe you're investing into a index fund or mutual fund so that it's a basket of stocks, or perhaps you are already having a retirement funds that pretty much still means a portion of it will be invested into stocks. Whatever it is, you are most likely going to be trading or investing into stocks at a certain point of your life. And let's say if you're doing that for 20 or 30 years, then it definitely makes sense to spend 3 to 6 months to really try and understand what your capital is doing for you and how are you supposed to perform well with your investments. There are actually two ways to trade or invest. Number one is to invest with your own capital. And in this case, I'm sure that's what most of us are doing. The second way is where you have a bigger organization to actually fund you. And usually the organization, the reason why they fund you is because you're a consistent trader or you have been proven that you have a portfolio of good track record. And in this case, because you get funding from bigger organizations, you have a bigger asset pool to invest and trade in, and it lowers your risk so that you don't have to make as riskier of a decision to make as much of a gain because of the amount of investment that you have. But because most of us are most likely only investing our own capital, that's what I'm going to be focusing on. All right, let's start with the very basic concept of stock. So what is a stock? A stock is synonymous with a share. It basically represents a partial ownership of the company through the earnings as well as the company's assets. So when an investor purchases a company's share or their stock, basically the investor has a claim on the company's earnings and profits. So for example, the company's assets could include their equipment, their products, and of course their earnings will be the profits, which are owned partially by the investor that owns a stock of the company. So for the investor or trader to actually purchase a company's stock, that means the company itself is willing to sell their share. So why would any company want to sell their share if they lose part of their ownership? Well, let's take a look at one example, right? So let's say over here, imagine a company, they sell a niche clothing store and they make 100K per year. The company want to expand internationally. So to open each store, they calculated that it would cost maybe around 200K per year. And they want to open at least 5. That means they need $1 million in capital. If they expand by purely saving their profits, which is let's say 100K per year, this would take many, many years to just open 1 or 2 stores. Whereas if they sell 50% of the share or like a percentage of their share, for example, and get $1 million from the investors, then they can grow at a much faster pace. So what I mean by that is, let's say these stores are open, 5 of them. Each one of these stores actually generate a revenue of 100K per year as well. This means that the company now can make 600K instead of the initial 100K only. This means that it is a much bigger portion of the pie that they're able to get. Investors, on the other hand, of course, is looking to buy stocks that are mispriced. So what I mean by that is they look for if the prices of the stock is too high or too low so that they can make a profit by buying or selling their shares. They're looking for companies because they want to invest, since investment usually means that you don't actually have to do any work, right? Money is working for you. And the investors will be earning through the growth of the company as well, because later they can sell the stocks or the shares for a higher price. Okay, so let's talk about like where do you buy these stocks? It's actually quite simple. There's only two ways to buy the stocks. One is through private, while the other one is through public. So whether if it's a private company or a publicly traded company. And most of us do not have access to purchase from a private company. Usually this means that you would have some kind of relationship with the owners, or maybe you're part of a investor that has a really large fund or asset, so that people are looking for you to invest into their company. But most of the time, we are all retail investors or traders where we are purchasing through public exchanges. If you cannot find a company on the public exchange, then most likely the company is a private company, right? So let's talk about the example, the clothing store. So for the clothing store, usually for smaller companies in general, that they are a private company. So when you are looking for the investor as the clothing store's owner, you'll be looking for fewer investors and through relationships that you have built, or maybe you can go through brokers as well. But in general, bigger companies such as Apple, Amazon, Google, etc., they went public, so that but they were all private at one point, and there is a process for the private company to go public, which we'll talk about in subsequent videos. So to invest in a private company, I touched upon that already. Most likely you have to have a connection with the owners, or maybe you're an investor with a large amount of capital. It's definitely not easy to find a good private company to invest in, because there could be a lot of risk involved. You won't really know if the company is actually going to survive, and we all know that 99 point, I don't know how many % of the company actually they do not survive, right? For the even the first 5 to 10 years. So it is much harder for private companies to get funding as well. Public companies is on the open stock exchanges. So for example, like NASDAQ or the New York Stock Exchange. And it also means that any individual can technically go through a broker to purchase from these public company their shares. All right, this concludes our first video. I hope you enjoy the content. Please remember to like and subscribe, and keep a watch out for more fundamentals on the stock market.